Hi, this is Randy Finney with Right Side of the Chart, and this is a market update for Monday, November 26, 2018. As we head into the final hour of trading today, this is the second video update in addition to a chart and some commentary that I posted on the right side of the chart this morning. That one was public content, the chart and written update. And then I did a video update as well for members this morning. And in that, I kept that members only because I closed out the QQQ official trade. Or I actually should say I closed out the QQQ trade right after that video. I did an update on the trade and then changed my mind and decided to close that trade out. Now, why did I do that? I had a response from somebody in the trading room was quite amusing that they seemed a little shocked that not only did I close out the QQQ active trade today, um, but I also started talking about potential bounce in Apple, listed some downside targets and potential bounce targets, some potential bullish developments there. And basically just said this, and this is what I wanted to convey in this video, is that there is certainly the potential for more downside. I think at most 3 to maybe 6% downside in the broad markets right now. Although the risk reward to remaining short or adding new shorts is very rapidly diminishing at this point and has been. And in fact, a case can be made, a pretty decent case for a bounce, and therefore I closed it out. If I can't make a clearly objective or well-defined case, bullish or bearish, to stay long, not only to short a stock but to stay short, because the thing about QQQ, if you're trading futures, you can put a stop loss order, and it'll execute almost around the clock. There's a lot of liquidity in the futures, but not so much with the index ETFs. They can gap up and they can gap up 2-3% just as they've been gapping down that much in recent weeks. So um, the developments I've seen, I'll go over real quick here. And before that, before I get into the charts, let me just share this. This is a post on right side of the chart today. Actually, I'm sorry. This is a post I made 3 years ago, back in September of 2015, and I talked about at the time cognitive biases that affect your trading performance. And I posted this in the trading room today. Let's say I recycled that post, and I think this is timeless. These are things that, and it speaks to really that reply from the the member in the trading room who would seem shocked that I've been talking such a bearish case and this can happen with the market and the unwinding and all that stuff still could happen where we could have a flush out move. We haven't seen any capitulation yet or any signs of true capitulation in the markets. Now the thing is too, at the top, a lot of people, and I recall this when we were short and I was bearish, and that we had sell signals back in early October, and the market started going down. What I was hearing, out there, the buzz on, financial media and in the papers and all this, was we weren't seeing the signs. Nobody believed that the market could drop as much as it did because credit spreads weren't going up, junk bonds weren't dropping. A lot of the warning signs, the red flags that usually occur, didn't happen, and yet the market dropped, as much as I figured it would. And likewise, I've been hearing lately a lot of traders, investors, and sure, I was looking for it, and I'll welcome it if it comes. It may still come, but they were looking for and are looking for a flush out move because a lot of, especially strong corrections, impulsive corrections like we've had usually end with a bang. What I mean by that is a big red flush out move, one large candle, usually larger than all the preceding candles, or at least at the upper end of the range. So a big drop in the markets, let's say a 3, 4, 5% down day in QQQ, something like that, followed by a very large surge in volume. That's what we call a selling climax. And all the better if you see a pretty sharp, strong reversal after that. So what happens in the market when too many people are looking and expecting the same thing? It usually doesn't happen. So by no means does that mean it can't happen. I just wanted to share that there's some things in the charts that tell me whether or not we're going to have that final flush out move. The risk reward isn't very attractive right now to either add shorts or stay aggressively short. And I said this too: if you're short QQQ, including the trade, the official trade I closed out today, by all means, if you think there's more downside, and there very well may be, set a stop or trail your stops down. Lower your stops to protect profits right now, and let your winners run, and cut your losers. So that's one option, but I just prefer let's close it out and focus on other things now. All right, enough of that. Let's just real quick talk about these biases, because this plays into, if you think I'm schizophrenic here, being, talking about the bearish talk and all these possible outcomes in the market, yet closing out shorts and even considering longs. I took a long position in NQ. Partial position last night, added to it today, and everything so far that I went over in the videos happened. We broke out of some support, some resistance levels on QQQ and NQ. Maybe I'll get to those in a second. But here's the biases you need to watch, and you can zoom in anytime you open an image on the right side of the chart. You can use a scroll wheel on your mouse, zoom in as close as you want. You can pan the image around. So anchoring bias, that's certainly one there. Um, but let's look at a few of these. Bandwagon effect, that's certainly a bias that affects a lot of people trading in the markets. Choice supported bias. When you choose something, you tend to feel positive about it, even if it has flaws. So that's one thing. In other words, people, because they went long Apple or they went short XYZ or QQQ, they can fall victim to that. And I'm highlighting these simply so you can be aware. We're all human, and some of these are harder than others to fight. Some of these don't apply to trading as much as others, so that's why I wanted to go through these. One of the biggest, and this is to me, it's probably the single biggest detriment to any trader or investor in the markets, and that's confirmation bias, where you tend to listen to only information that confirms your preconceptions. In other words, you hear what you want to hear and agree with it, and then you dismiss what you don't want to hear. So when the naysayers come on and they're talking about something that goes against your position, you just dismiss it. So that's a big one. You got to avoid these. Let's see, what else do we have? Of course, there's information bias, the tendency to seek information when it does not affect action. More info is not always better. I say that. That's one reason. And I don't know whether I can't recommend. Everybody's different how they're wired, what type of inputs. But I can tell you there's a lot of people that sit there and watch CNBC or Bloomberg for hours on end. You're going to have information overload. Just be careful of that. Too much information, too much conflicting analysis leads to what we call paralysis by analysis in trading. You're going to hear bullish side, you're going to hear the bearish side, and believe me, they march those people out there. They make a good case, whether it's bullish or bearish, and sometimes I'll do the same. And if I can make an equally strong bullish case as I can a bearish case, guess what I do? Nothing. There's no trade there to be made. I want to see a clearly bullish or bearish case. So, anyways, these are some of the different things. Outcome of bias over for confidence. That's certainly one that we know can hurt us. Recency bias. This is a big one as well. I want to talk about this right now because what's going on? Well, we've been in a downtrend for a while. The same reason the dip buyers and the people that were bullish for years because the market was going up were in denial when the correction started in October. Didn't want to short, didn't want to sell their positions, but finally do. And now that the market's been going down, then you're prone to recency bias, thinking that the tendency to weigh the latest information more heavily than older data. Market investors think the market will always look the way it does today and make unwise decisions. So there it is. Anyways, you can check this out. I posted that in the trading room, but I can give a link if anyone's interested to the where it is on the site and give you a copy of the chart. So I just wanted to point that out now, because that does play into some of the things that the analysis that I'm looking at right now. And so here it is. So basically, if you missed today's video, which again was for members only, I was talking about the divergences, and I pointed these out, I believe, last week. QQQ and a lot of the top components. I'll show you those real quick. Microsoft, these all have positive divergence right now. There's Microsoft, there's your divergent low coming down to and at trendline support. As I often say, divergences in themselves are not a buy signal, but they are an indication of that a trend reversal is likely. And so far you can see the Microsoft put in that divergent low with this big doji stick last week. On Tuesday it was, and so far it's been moving up since. That PPO is starting to curl up. It's still not confirmed. I want to see a bullish cross, but so far so good. And the fact that it hit support and it also was coming off oversold levels, that adds to the bullish case. And again, This is one of, if not now, the biggest. Somebody posted something in the trading room today. Apple's dropped so much that Microsoft may have now regained the title as the largest stock in the world based on market cap. So there's, I just want to point out, these are market leading stocks, and they're also the heaviest components of SPY and QQQ. You have Amazon as well, put in a divergent low last week and has been moving up. See the bullish divergence there. Alphabet, divergent low moving up. So these are the reasons, that I've now shifting. And although I may not be at this point in time, we're not aggressively, I'm not adding official long trades, but I may by the end of the day. And I've thrown out some of these trades and, QQQ and NQ as a day trading op this morning in the trading room, and may add some official trades here soon. But there's still a little bit of work to be done, and let's talk about that. Let's talk about what kind of work needs to be done. 60-minute chart. QQQ, here's a downtrend line. This is a level I talked about this morning. We had resistance here about 160.20 on QQQ. This is today's trading. These are the candles. So we hit it this morning, and then I said at that point that we need to pop above, it was after that second candle, that a break above today's highs should be bullish and could continue to build on this rally. And that's what we had right here on this candle. The 3 p.m. candle took it out. And so far we're above there. We're not moving up strong, but remember the Qs are already up 2%, 2.1. And I think it will be interesting. That's why I wanted to get this video out to see if the sellers come out of the woodwork again in the last hour of trading. Will they sell this rally? Or will we see a change of character and see this rally get built on, or these gains hold? If so, that would be another check mark there in the bullish case. And just to clarify too, because I'm all over the place here, I'm only looking for a rally. I do believe there's been so much technical damage to the charts that more than likely a top was put in October, early October, late September. I'm open to all possibilities, but at this point in time, I'm looking for rally. I certainly there's some work to be done to firm up the bullish case. We could easily have another flush out move, but it's about risk versus reward. And I think shorting here is sort of like picking up nickels in front of a steamroller. If there's only maybe a little less downside compared to the upside potential. So bullish events, what we need to see from here, a break above 163.45. That's minor, very minor resistance. This is again a 60-minute chart. Here's a potential downtrend line. Why do I call it a potential downtrend line? Because in my opinion, you have to have at least 3 reactions to validate a trend line. We don't have a reaction off that trend line yet. A reaction will be a pullback or an extended consolidation like this where we trade around it and then either move back or break out. Right now we're testing that trend line, but I've always said, or at least in my opinion, any 2 points can be connected at random. So it's that third distinct reaction that helps to validate a trend line. So watch for a break at that level, especially if we consolidate around there, maybe park it there today, pop above it tomorrow, or pull back. If we pull back, that's just another reaction, then still a trend line to watch for a breakout. Let's talk about SPY for a minute because QQQ is not the market. It's one index, but it's about 100 stocks, but it's not as well, it's not as diversified as the S&P 500 or the Dow or anything else. Here's a potential trend line to watch on SPY with some levels. You can see minor resistance. This is a pretty big level up here. I think if we have a near-term rally, look for reaction there. Maybe that's a place for short-term traders to take some profits. But again, at the point we're at in the markets, we should either see some, I think, this week, or probably this week, no later than next. If we're going to have a flush out move, I think it'll happen soon. So if we start to move up here, it's sort of it turns that momentum, and we may not break and get that waterfall sell off. And the more we push up, the more green days we have. If we build on today's gains and we continue to move higher, it won't completely eliminate, but it will reduce the chances you're going to have that one last flush out move and another 3 or 6% or so downside. So those are levels to watch. And right here, let's just watch these near-term levels on SPY. I also wanted to mention that unlike the NASDAQ 100 QQQ, all the other indexes do not have positive divergence. Now, again, is positive divergence a must for a trend reversal? Absolutely not. But it does help when you can get a divergent low on the daily chart, especially if we are in a new bull market. If you believe this is, I'm sorry, not a new bull market, we're still in a bull market that will be going to new highs. If you believe this bull has plenty of life left in it and will go to new highs into, into the end of 2018 and quite likely beyond into 2019, then you should be buying with both fists. I can't tell you what to do, but I can tell you that when you have positive divergence on the daily time frame, and you can go back a long time, many years, last decade, this was good for rallies that took the market up to new highs. They're very rare in a bull market. We haven't had many divergent lows because we haven't had many corrections deep enough to give us that. And when we have, I think the last one was back, and I posted a chart again on the front page this morning, was back in early 2016 after that big correction we had in late 2015. And that set up one of the biggest rallies that we've had in this bull market. So there it is. Now we don't have it there yet, but again, it is not a necessity, nor does positive divergence, if we get it, guarantee that you get a trend reversal. But it would still fit well. There's very nice support down there around 257. So what are we talking here? Let's forget about today because I've been talking about the risk reward. Let's just grab Friday's candle. From Friday's candle, we were talking about 2.3%. And now we will talk about today. From where we're at today, some less than about 3.5, a little better than 3.5% downside. Doesn't mean we have to stop there, but that's pretty darn good support, and that's the level I've been eyeing pretty much since before this whole thing even started. So, like I said, almost coin toss odds whether we're going to get that last flush out, but it would not surprise me if we don't, because a lot of eyes are looking for that thrust, and it would certainly give us a nice setup, but almost too perfect. And when you have such a perfect setup and a lot of eyes looking for the same thing, and I said this weeks back, and I've said it many times since, one of two things usually happens: either you fall shy of the target everybody's looking at, or you slice through it and then reverse. And that they all buy there, they get stopped out, and then you get a nice reversal. Or you reverse shy of it, and it denies an objective entry. It denies the shorts an easy out, and it denies the longs an easy in. And that's what the market likes to do. It likes to make it tough, difficult for the masses. So there it is, SPY, and I could go down the line. DIA, that's the Dow. A little more downside in the Dow, or Dow ETF would have divergence. MDY, it's a mid-cap ETF, doesn't have bullish divergence yet, but it would if it makes another low. And then IWM, small cap ETF, doesn't yet have divergence, but again, it would if it made another low. But it's also at pretty decent support. That's the thing. It already hit that support once. You can see it's been pretty decent support there. And so it's almost a double bottom in IWM. And again, if it does happen to eke out, make an equal or marginal new low there, there's plenty of room for bullish divergence on IWM. So, if things get really ugly, we can still flush out, but I don't think a flush out would be much more than, like I said, maybe 6% from where we're at now. And the odds of that are starting to decrease, I think, with the divergences in not just divergences, but a lot of those key components in the S&P or NASDAQ 100 falling down to support with divergences and while oversold as well. Okay, and for you futures traders, we'll just wrap it up here. This is a 60-minute chart of NQ, the S&P 500 E-mini futures. We've had since last week a divergent low. There's your positive divergence right there. You can see all the divergence lines. These were all divergent highs and lows. Sometimes you have a little divergence, leads to a little pop, then a small divergent that's led to that big impulsive selling. But so far, we've stabilized, and the market has been consolidating here. So if we're going to have a meltdown type final flush out move, I really think it would need to come sooner than later. And the longer that we hold these levels, and the more we push up, the less likely I think that is that we're going to get that. So we'll see. Anyways, here's we popped above. You can see we took out this previous reaction high, and I don't see much. There's some minor resistance here in NQ. Let me give you a level there for you NQ traders, and that would be right around that reaction low there. You have a reaction, little reaction high, reaction low, some reactions there. So there's your levels to watch, about 67.13. And then a couple more up there. And this is a pretty big one, about 69.06. I think if we get there, let's watch that. That's probably I hate to use a term make or break level, but it's a pretty important one. So we'll watch that if we run up there at about 69.07 or so. And then finally, ES for you ES traders. These are the S&P 500 E-mini futures, also a 60-minute chart. Similar story here. We had recently bullish divergence. There's your 60-minute divergence. We had a little falling wedge. It broke out. Failure to launch. Looked like the breakout might go, but then it stopped. However, what we did is we came in. So far, it's not really a failed breakout. We went down, we slightly undercut the lows, but in doing so, we extended the bullish divergence. So we still have a divergent low, and now we have this is really defining itself as a pretty important level, about 2672. You can see that previous reaction. We're testing it. We already tested it once today, pulled back. We're testing it again. There was a reaction there and some reactions throughout here as well. So this is the bullish scenario. This is what I'm leaning towards right now. And again, if we get that in the final hour of trading today, by the time you get the video, the market's probably going to be closed. But we have a little less than half an hour to go now. Let's watch. Otherwise, anything's possible. If they come in and dump this hard, especially if they fade all of these gains and then some, uh, maybe part of those gains today into the close and then more downside tomorrow, then, well, the selling's not over. It's as simple as that. So that's why I'm laying out these scenarios, and I think the best thing to do is keep it light. I had a question put to me on right side of the chart. We have the lowest number of trade ideas we've had over the last month because what I'm doing is closing out short positions just because the it appears to me that the risk reward is starting to shift from the bearish side to the long side. By no means does that mean we have an all clear signal to buy and go long yet. But what I'd like to do is start closing out, and that's what I've been doing, reducing short position, book some profits, lighten up, go into cash. Sometimes I can nail a bottom on a move in reverse, and I do that over the years. I've done that many times. Nail a bottom or a top with near impunity, and I close all my shorts. And I actually hit a button on Interactive Brokers. If you're long 3 contracts or whatever your number is, you can set a order to sell 6, and it'll reverse that trade. So it'll close out the 3 longs and immediately give you 3 shorts at the same price. And you can do that probably through some other brokers. But in this instance here, I'd rather have a soft approach, kind of scale out of the shorts as the RR diminishes, build cash, and then probably when this thing runs its course, whether that has already happened or not, or there's a little more downside, start scaling into longs, whether they're index longs, sectors, individual stocks, whatever looks attractive, and not try to make an all or none position change there. All right, let's leave it here, and we'll see how today closes, and then of course follow up tomorrow as well, and I'll keep the updates coming because I think now that the holiday week is over, we'll get back to trading as normal here, and so I think we'll have a good idea. Probably, I think we'll have a good idea by the end of this week as to where the next 5 to 10% in the market will be. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.